Good afternoon and welcome to this webcast looking at the adoption of ESG principles in fixed income investing. I'm Will Mitting, the founder and managing director of Acuity, and I'm welcome to you all on behalf of our hosts, Eurex, today. I'm going to begin with a few housekeeping rules. If we get the housekeeping slide up, you can read them through there, but essentially it's Chatham House, so please don't quote anyone without permission. Please do ask questions. We're going to be asking questions that come in throughout the webcast, so please do feel free to put them in the chat function, and I'll ask them as and when they come in. So this webcast is being recorded and will be made available to you soon after the live presentation. Also, please close other browsers to optimize your viewing experience. And if you're watching on a mobile phone, please note you can change from the slide view to video view by swiping left or right. Thank you. ESG is a globally established concept in capital markets today. While initially embedded in the equity markets, ESG is now a prevalent investment strategy across multiple asset classes. Today in fixed income, the ESG landscape comprises over $53 trillion in outstanding bonds and is leading to the development of new instruments from green bonds to sustainability-linked notes. In September, Eurex launched the world's first listed ESG fixed income futures on the Bloomberg MSCI Global Green Bond and Euro Corporate STI indices. These marked a significant step forward in the development of an institutional capital market around investing in fixed income ESG. Joining me today to discuss these and the wider adoption of ESG in the market is Lee Bartholomew, Head of Fixed Income ETD Product Design at Eurex, Pierre Bergeron, Cross-Asset and Green Bond Strategist at Société Générale, and Mahesh Bimalingam, Chief European Credit Strategist at Bloomberg Intelligence. Gentlemen, welcome. Today we're going to begin with a look at some of the broader themes in the fixed income market overall. Then we're going to turn to how ESG is being applied to fixed income, and finally we're going to have a deep dive on the fixed income ESG futures. Yeah, let's jump ahead a little bit to ESG ESG and fixed income. Obviously, the stats mentioned at the beginning, 53 trillion is quite immense. But how's it evolving from your perspective? What are you seeing? Where's the investment, and what's driving change?
To be honest, looking at ESG and equity research for the past years, it was just a real growth, very impressive growth to take into account environment, social, and governance ratings in the equity research. And now it's moving to the fixed income, as you said, and we notice that all players, I mean, credit rating agencies, but also buy-side, sell-side analysts, are now added extra financial to build credit ratings, taking into account environmental, social, and governance into their global opinion on an issuer. Now it's time for me to move ahead, more granularity on the environmental ratings by taking into account carbon data into ESG and to explain how to reduce carbon footprint in the portfolio. Talking about green bonds, and this is the main growth, the main driver growth today in the sustainable bonds. We do believe that this green bond segment is just at the beginning of the growth. It was already impressive over the past decade, and we are now close to, let's say, north of 400 billion issuance expected for 2021. And we expect that the cumulative issuance of green bonds should be north of $1.5 trillion in 2021. And we expect even more in the future, talking about around 2.5 trillion cumulative issuance for green bonds by 2025. And you will ask a question about the importance of green bonds compared to the global bond market. And I agree with you that green bonds, even sustainable bonds, is still a niche market, but this is a promising segment. And why? Just because we have high appetite from investors, particularly green bond funds, but also ESG funds, to invest in green bonds, and also from green bonds issuers to finance green capex and to support their zero carbon strategy.
Interesting. Are there any particular sectors, Pierre, where you're seeing the most green bond issuance?
We have three sectors now as the top players, namely utilities, energies, and transport. This is the main sectors for the production of greenhouse gases, and also the main sectors that are very active in the green bond market because they have green capex to finance, and we have high appetite from investors to finance those sectors.
Okay, interesting. Well, we'll come back and touch on a number of those topics. But Mahesh, I think are you dialed back in there? Is that sort of...
Hello?
Mahesh, perfect. We can hear you perfectly. So, yeah, but back to the ESG side of fixed income, the massive investment. Traditionally, it was said that bondholders had less of an influence over corporate policy on account of the fact they couldn't attend shareholder meetings, etc. Is that changing now with the issuance of ESG bonds? Are you seeing fixed income investors taking a more active role in steering corporate strategy as a result of the ESG issuance?
Yes, this is totally true, and we do believe that green investors are the major players for the green economy by greening finance. And so they are the top players to avoid greenwashing. So we do believe that these green investors will become more and more active, particularly to adopt ESG principles and to green investments for asset managers and the green investors, generally speaking.
And Lee, from your engagement with the market and the build up to the launch of the futures, what were the key trends that you picked up on that drove your appetite to launch in the market?
So I think the way we look at it is a much more kind of holistically. So I think if you look at fixed income and electronification, then Pierre, I'm sure, would attest that kind of fixed income from an ESG perspective prior to 2020 was probably lagging between 12 and 18 months behind that of equity markets, right? But that accelerated through in 2020. And what we felt was important when looking at how we build a portfolio was look at where our strengths lie as an exchange, and that's very much within the derivative space. So our approach has been to build a portfolio of products that are complementary to one another and can help evolve liquidity. So we made the first step into credit, as I would like to say, with ETF derivatives, right? And from there, we saw a natural extension to look at ESG derivatives as a way of accelerating the electronification around derivatives on that front, right? So very much see it as a portfolio of products that enables the end user to access liquidity. We don't see it as replacing the market, the OTC markets, but we see it more as complementary, right? So in terms of, to your question on pickup, there was a lot of interest about us creating a product which was capital light for end users, but also gave them access in a transparent way. And I think whenever you're looking at transitioning markets or being part of the transition and electronification, you need a tape for the end users to start to evolve in order for the adoption of the product to pick up and also cater for a broader remit. And that's what we looked at when we were considering the underlying.
And in terms of the interest you've seen to date, where's the major interest coming from, and where are we in terms of the kind of the building out of the instruments?
So in terms of liquidity, so the products have got off to a strong start. So I think it's got off to a strong, and albeit kind of slower than the equity start, the equity products. So in terms of the interest, you tend to find that the interest is coming from real money. In that space. And in terms of liquidity, what's been really, I think, a good sign from our perspective is the execution of orders in the order book, right? So at inception, it was key that we brought together a diverse set of liquidity providers, which we've done. So we have the banks, as well as the non-bank LPs. And I think the non-bank LPs are comfortable quoting the products because they're in the equity markets, they're in the cash ETF, and they're also in index products. To your point in terms of the evolution of that, volume is picking up steadily. So I think the key to that accelerating into next year is around kind of client readiness. So we're very much focused on working with those clients that have shown an interest, going through the product approval process so that they're active in 2022. And I think you will start to see that pick up. So we've seen north of 1,000 contracts trade. If you look at the price picture in the order book and so forth, it's comparable to that of ETFs, which I think is always a good sign. And clients have been comfortable getting risk on and taking risk off. So I think open interest stands just north of 80 million. So it's good overall.
Yeah, one of the key challenges with any futures contract is to consolidate the liquidity. In ESG, it's particularly difficult because of the different approaches that investors have to how they view liquidity. Before we hand over to Pierre to talk a little bit about how things like the taxonomy are evolving, from a futures perspective, building a listed product, how did you overcome the challenges of selection of the right indices and making sure that you encompassed a broad enough market without omitting anything that people weren't particularly keen on?
So I think when you look at the equity market, there are clear leaders when it comes to indexation and in terms of methodology use, whether that's exclusion, inclusion, and so forth. And on the fixed income side, that formal benchmark hasn't been yet established. However, the underlyings that we've chosen are the de facto benchmarks that a lot of the asset management community have been using in order to benchmark their performance and tracking error against. So for us, what was important was about selecting the right provider that the market was naturally gravitating towards. And I think if you look at the underlyings that we've chosen, then they are significant in terms of from an AUM perspective. So that's something that we will see was one of the main reasons for the choice that we chose in terms of underlyings. And we think in terms of product, we can then iterate further, but I think it's about building liquidity in the current two underlyings initially, and then we will look at iterations in terms of dollar denominated and pure credit.
And Pierre, there's a lot going on in the background to this, with the whole ESG movement, and particularly the EU taxonomy. How is that impacting availability of instruments, and what's holding back the market currently?
We do believe we are moving to greener economy, to greener industry, to greener finance. And you notice over the past weeks and months and years, so many climate conferences like the recent COP26. And we have more and more national determined contribution from the country, but also zero carbon strategy, particularly for sectors like utilities, energies, and transport. And we do believe that the European taxonomy will move ahead, taking into account this period of transition to open debates on specific issues like nuclear power plants, and with that to open the door to green assets. And these green assets mean sustainable bonds and derivatives to improve the green financing. So we do believe in this green economy, and we do believe that all these green assets will be ready to be financed by a sustainable bond, generally speaking, and particularly green bonds and sustainability-linked bonds.
And there's obviously the EU's got the big bond program at the moment with the Next Gen initiative. How will that change liquidity and just the sheer scale of the market?
I mean, it's very important, as you said, to improve the liquidity, and we do believe this, let's say, flexibility of the European Union taxonomy will add more liquidity, more green assets. But we have also to keep in mind that this green economy is a little bit limited by affordable technology more than green appetite from green clients. If you take the example of the auto industry, for example, we know that we have, let's say, nearly zero carbon with electric vehicle excluded the issue on the battery. But on the other hand, we know also that we have some limitation, practical limitation in this electric vehicle, like the selling price, which is making the green bonds to finance green capex in the auto industry not yet at the level we expected with the ambitious green strategy from some car makers, German car makers, for example, that are very ambitious in electric vehicles. So we do believe it's just one step right now, and we expect that in the coming future, with new technology, affordable technology, sustainable bonds will be there, the liquidity will improve, and so derivatives on these sustainable bonds will be there.
Interesting. Mahesh, in terms of the overall market for ESG and fixed income, how does it compare, and what are the key trends you see in that respect?
Right. So to continue with what Pierre was talking about green, so let's talk about green credit. So if you look at credit markets, green bonds, yes, they've been growing by about 25% per year in terms of supply. But the problem is this year, even the normal market grew by about 20% in terms of gross supply. So overall, the green index, Euro credit, is about 153 billion, right? Now, how does it compare with the Euro investment grade market? That's about 2.6 trillion, very small. I would have thought, because it is a very small niche market, you could have some divergence in performance. So last year, for example, when we had the COVID sell-off and so on, green bonds outperformed. So in 2020, green bonds outperformed. Correlation dropped to about 85%. But this year, because it is a normal year, correlation is above 95%. So literally step-by-step tracking of returns, and there is no, statistically, there is no difference in performance. It's about 5 basis points for the whole year, return difference. So the way I would think is, if I buy green, there is no penalty. Last year, there was a reward. This year, there is no penalty. So in some credits, yes, green bonds do trade about 3 to 4 basis points tighter compared to the normal bonds. But overall, in terms of returns generated, green bonds seem to be delivering the same. Last year, by the way, 30 basis points, just to give you a scale of difference. In terms of overall ESG, though, the one issue I have with ESG indices or SRI indices is the definition is very broad, and hence they tend to have more or less the entire index as part of it. So there generally tends to be almost identical performance. So if you look at SRI corporate, right, in Europe, it is about 2.2 trillion euros. Euro investment grade is 2.6 trillion euros. So the performance is literally identical, right? That is why I tend to prefer green bonds. They're more specialized. The bonds are designated. They all have a sticker. There is some chance of divergence and outperformance rather than the generic SRI definition. If you look at overall global ESG fixed income, the Bloomberg global ESG is about 94 trillion. And one fact I would like to bring out is the ESG indices have less restrictions. So they don't have a restriction on maturity. They don't have a restriction on outstanding. And as a result, the ESG index is actually larger than the Bloomberg Global Ag. The Bloomberg Global Ag is about 68 trillion, has a lot of restrictions. The ESG one is 94 trillion. So just to give you an idea.
Lee.
Yeah, I think there's another thing I think I would add on a look at fixed income. Although fixed income tends to lag that of equities in terms of electronification, or what I would turn around and say in terms of standardization in an exchange format. What you do see is when products have tape built up and asset managers really get comfortable that they can put on risk and take risk off, then you tend to see the sizing of risk scale, right? We've seen that in our ETF products, right, where end users have been able to get up to $1 billion of the AUM of the underlying off in one side. I think one nuance on the fixed income side is obviously the integrated nature, right? So when you're looking at kind of the borrower market on these products and so forth. But I think the liquidity providers in the current products are doing a great job, right? So they're actually able to show, I think you asked earlier, the spreads are around 8 bips consistently, right? Give or take, even in volatile periods. So once you start to see some, more to Mahesh's comments around dislocation, you'll then start to see more participants come in to use the products, right? I think that's also key for the products to kind of evolve, or put another way, the ecosystem around kind of derivatives, cash, and functionality within portfolio trading, as an example.
Yeah, good point. I want to come back to some use cases on the futures that follow up your comment there, Lee. But just back to Mahesh on your point about the difference in performance last year. What drove that dislocation, and are we in a position yet where we can say the green bonds are inherently expected to perform differently from traditional bonds?
No, there is one key reason, right? Scarcity. Given the extreme scarcity of green bonds, the ones that have the sticker, they are very closely held. So green bonds, particularly in credit, once bought, I can assure you they don't get sold. So in a market crisis, if I have to sell, if I believe that there is a trend downward market going on, I am going to be selling stuff that are probably not green. I won't be selling the green bonds because I won't be able to get hold of them again. Given the severe shortage, particularly last year, during the crisis, I don't think we saw literally any selling of any green bond. And they all, by the way, the green bonds tend to be one key difference. If you look at the sector split, they tend to be higher rated. They tend to be from higher rated entities than the index. And two, it is dominated by lower risk companies. So for example, utilities are around 40% of green bonds. Financials are another 40%. Industrials, very little, because industrials, they don't have any green rule on them that they need to issue. So as a result, utilities dominate the green credit market, which means it is inherently lower risk, better rated, lower risk sectors. So last year it played very well. But this year was a risk-on market, right? So as a result, you saw similar performance.
Pierre, anything to add to that? I see you're nodding away.
Yeah, maybe as a follow-up, I would like to add that most of the green bonds are investment grade category, meaning that if you look at the gradient, the difference in price or in spread between a green bond and comparable non-green bond, you notice that first, this premium is volatile, sometimes positive, sometimes negative. And second, it's come as no surprise that in the high yield category, we have higher premium. So could be a source of interest for investors to monitor this premium and to invest in the issuer or in the rating category that are very attractive in terms of difference in price or spread between green bond and non-green bonds. But we do believe that behind the rise of the green bond market, we expect that more and more green assets will come in the market. We need to be financed. And so the green bond market will continue to rise, and the appetite from investors will be driven by this promising green bond market, and it will be a support for the greenium. And we expect this greenium to increase in the future, despite some comments from the issuers saying that green bond needs additional cost for the issuance due to the expertise, third-party opinion before the issuance, and also the annual review most of the time by the external auditors to check and double check the use of proceeds in a way to reduce greenwashing. So, but we are still supportive of the greenium moving ahead.
Lee, have you got anything to add to
that? I think what you tend to find, and I think you was asking about use cases earlier, is more how the different client segment types will use the product, right? So if I'm a factor-based investment team that's kind of leveraged and short cash, and they're adding an ESG aspect into their business, then they want a product that's capital efficient, that they can express long-term views on and use futures to use it, versus kind of tactical positioning, right? And I think to the point that we just discussed there around kind of ESG, non-ESG, you will bring more participants in as you get more volatility of spread between ESG and non-ESG, and then that will attract more participants in, and also that gives greater opportunity for arbitrage, right? I think to the point that Mahesh, I think, made earlier, as clients in 2020 wanted to get exposure, they've tended wanting to get in and be long only, right? So in order to develop the pool, you need to bring in more participants, and I think you're getting people that are coming in that will want to take different views and express it in different ways, and therefore then you start to see other aspects evolve quicker.
Yeah, and absolutely. And we've got a question from the audience. What effect does ECB buying have on green bonds in credit and rates for 2022 if tapering comes along with next-gen EU green issuance? Mahesh, probably one for you first. Yep.
Yeah, I'll take that. So the ECB credit portfolio, if you look at how much percentage is green, very tiny. As I said, there is only 163 billion of green credit, right? By the way, most of it is financials, right? The 43 billion they cannot 43% they cannot buy. So that doesn't leave them with much. So in terms of ECB not buying enough credit and its impact on green, I wouldn't worry too much, because they didn't buy much last year. Impact in terms of green bond valuation, because the ECB is tapering next year, that's a non-event, because they haven't bought much.
Pierre, any thoughts to add to that?
Yeah, maybe I could add something on different asset class, which is sustainability-linked bonds. And we noticed that the acceptance from the ECB started beginning of 2021 was a trigger for this market, for this asset class, and we notice a high appetite from issuers to issue sustainability bonds because of this support from the European Central Bank. So I agree that if the ECB has less appetite in the future for sustainable bonds, generally speaking, this could have an impact on the valuation first, and maybe on the volumes to be issued by issuers. But on the other hand, we need to balance that one by the green capex and the expected higher volumes of green capex going forward. So I'm still very positive on sustainable bonds, generally speaking, and green bonds in particular.
Lee, anything to add, or?
Yeah, I think, look, I think the market getting into or the potential for there to be divergence of opinions at central bank level is good for markets in general, right? And I think when you get a decoupling on the credit rate side, then that tends to lead to opportunity, right? So that is something that I think is more additive than necessarily a negative impact. We know that the ECB wants to issue on the green side. Yes, they'll have to take those considerations in, but I think they've been forward planning quite well in terms of that particular aspect, right? So for me, it's not a cause for concern. I think it's an opportunity, and people should view it as that, and that's certainly something that we hope will help in the development.
And presumably quite a good opportunity for futures markets as well. The arb there, you can see it, you can imagine it already.
Well, hopefully, I think, you know, as I said, I'm kind of not you know, I'm very fortunate to kind of be asked to speak. I think the expert in my team is Davide for sure. But I think we're building everything in the right way, and that's something that we will continue to do as we get through to next year. And that's, you will get, as more clients become active, I think you'll start to see more volume come through.
And just back onto the futures, Lee, we talked a little bit about the overall market, but can you give some examples of specific use cases and benefits that you see, and how you see the futures playing a role in the growth of the overall market?
Yeah, look, I think anything when it has in fixed income, it's about, I would say, better integrating, as I call it, the verticals or the different aspects of the market, right? So you're seeing I think there's an article out in the FT today that kind of sees corporate bond markets at the kind of, you know, the kind of at the start nascent aspect of kind of electronification, right? And everyone is looking at that in terms of how that evolves and where the equities were back in the 80s and 90s. You're seeing more technology functionality being used for clients to get access to liquidity pools, right? And the reason for that is because you're having the addition of non-bank LPs who compete in the index space and ETF space, trying to kind of grow the reach into new markets. Having said that, you still have the you still have access that the clients want. So to answer your question, I think if you're a long only investor, then you're certainly looking at kind of using the products to put risk on, both from a long-term and tactical perspective. And I think you see it as much more as an additive part of your execution strategy, right? An overall risk. So I see that evolving. I think for the fast money, it's looking at ways, and the systematic community is more looking at the arbitrage, to the point we were raising earlier around ESG, non-ESG pricing. And I think it will be more, fixed income will be more about taking a multi-angle approach rather than one size fits all, right? So I think you're definitely going to see it as part of a toolkit rather than this is what we're going to do and this is the only way we're going to do it.
And in terms of the evolution of liquidity and pricing, you talked about the good progress to date. What do you expect in 2022 and beyond?
So look, I can't say anything other than praise for those that are making markets at the moment. I think, to the previous point, there are those that will use OTC total return swap markets and will use other products. Currently, they will look at how the products evolve and the risk profile that gives them versus current setup, and I think that will continue to accelerate. I think from the liquidity providers that we have, both in the order book and off the order book, then that will increase in terms of their reach, right? So I think it's a topic that's prevalent on a lot of members' side, and they're figuring out how to access these markets, and that will only speed up in 2022. And I think, look, the spreads and the sizes being shown in the order book, I think, as I said earlier, is comparable to alternative markets, and I expect that to continue.
Indeed. We've got about 5 minutes left, so Mahesh, I want to go top and tail, go back to the the original discussion that we began, but maybe pointed a bit more towards 2022. What do you see as the kind of major themes going into the new year that will dominate the fixed income landscape?
First thing is central bank policy. I mean, we do a survey, by the way, the only kind of survey especially for the high yield market. And in that, this is not my opinion, client opinion. Majority clearly say that central bank policy will be the key driver for returns next year. That's the first thing. Second is, yeah, inflation is a worry. How is that going to play into rates? Rates impact is the second worry. Now that is less of a worry for high yield, but more of an impact on investment grade, as I just mentioned, because of extremely low break evens. So investment grade is 9, while high yield is about 80, 85. So the break even ratio is about 13. So if you're worried about rates, you more or less have no choice next year. Given that there are no defaults, no fallen angels as of now, and you believe that Omicron is not going to lead to lockdowns, right? If that is the base case, you have to be in high yield, because in other parts of fixed income, you're absolutely going to get killed in 2022, certain negative rates. So already this year, you saw about minus 1.73 returns for IG. This is this year, especially with mild rates. Next year, as you know, if you look at various rate strategy forecasts across the street, you're looking at the 10-year moving anywhere between 30 to 60 basis points. If that is the case, it is going to be absolute murder in rates as well as in investment grade. So those are the two key dynamics. Fundamentals, as I mentioned, are not a worry because they're very strong right now, and I don't see that dropping unless there are a series of new lockdowns. From what I can see, European governments particularly are focusing on the unvaccinated to ensure that, okay, we cordon those guys off and we avoid lockdowns. The UK government, as you know, given their bent of mind, they are now going to lock down as much as they can. So if that is the case, I think fundamentals will hold. So central bank policy and rates are the key themes that I would be worried about next year.
And Pierre, from a green bond perspective, what do you expect to see in 2022?
I do believe that 2022 will be another strong year for the green bond market. If you remember, 2020 was a kind of difficult year because of the COVID-19 and so many social bond issues to solve this issue of COVID-19. So we have a recovery now in the year 2021, and we expect again more green assets in 22. And so another strong year for the green bond market, and which could support, in my view, more higher greenium in 22 compared to 21, because we expect more green bond funds, more ESG funds, higher appetite from investors for sustainable bonds. But the competition will be tough between the green bonds and sustainability bonds that have constraints on the use of proceeds, and these new joiner sustainability linked bonds that have no constraints on the use of proceeds. And in addition to that, is a way to highlight zero carbon strategy for the issuers. So the competition will be tough between asset classes, and we expect investors to support these promising markets and to have less appetite for non-sustainable bonds.
Interesting. And Lee, I'm going to get. Oh, sorry, Banesh, please.
Yeah, so I just want to say the green bonds in high yield are extremely scarce because it is dominated by industrials, right? Utilities are very tiny in high yield. So in the industrial space, companies issuing green bonds out of their own choice, very, very tiny. So that is one main reason why there is a greenium in high yield. As long as it is that scarce, I think it's going to persist.
Interesting. Absolutely.
But I agree with you. It's the high yield category is a very small category amid the green bonds, but we expect more high yield issuers to come in this market.
Lee, I'm going to hand over to you for the final words. What does 2022 hold for the futures products, and what can the people listening today do to engage?
So I think credit is more to the team than to myself in terms of the product development side. I think we have a very specific roadmap that we'd like to execute. I think the focus for us as a team is to build the liquidity out in the current underlying. So I think that will take focused effort with the end users in order to do that. So I think if clients are interested in the product, then they should definitely reach out to the team, and we will follow up on that in terms of next steps. For me, I think the points that were raised about divergence and central bank policy rates and credit, as I said earlier, it is an opportunity, right? And I expect to see 2022 to be another strong year for fixed income, especially if you get a continuation in terms of a backup in rates, and then what that then means for corporates and so forth. So what we will do is look at iterations on the current product suite and add products that we feel are complementary not only to the ESG futures but also to the ETF derivative segment, right? Because I think for us it's about building that product and then wrapping around functionality so that clients can better access those markets and the liquidity pools that you're seeing.
Thank you. Yeah, I totally agree. It's going to be an exciting year both for fixed income next year and also for the continued growth of ESG in that space, and obviously the futures alongside them. So that brings us up to time. So thank you very much to my panel. Thank you to Eurex for hosting us, and thank you all for listening. Thank you. Thanks all.
Thank you.
Thank you.
Thank you.